Good morning, good afternoon, good evening, traders, wherever you are in the world. I hope you're doing well. I hope you're safe. I hope you're healthy. I hope you've got a big smile on your face, and I hope you're catching pips as usual. Pips of Persia here with part 2 of our Wyckoff introduction series. In today's video, we'll be discussing accumulation and distribution schematics and the meaning behind them in a very simple and easy to understand way, because in my opinion, there is no reason to overcomplicate these concepts just because you feel like it may be a little bit more advanced to what you are used to. There's no reason to overcomplicate it. So we're going to break down Wyckoff schematics together in a way that hopefully every single one of you will have a very good understanding of by the end of this video. But before we speak about that, there are a few major points that I need to mention. One of them being, do not rely on Wyckoff only for your analysis. The mistake that a lot of traders make is they open their charts and the first thing that they want to find and the first thing that they look at are Wyckoff schematics. Hey, where can I find an accumulation or a distribution? And they get really surprised. Even if they mark up the perfect accumulation or distribution, they might still see the market going against them. You have to understand that you cannot use Wyckoff on its own to analyze charts. Market structure is extremely important. You have to know whether you are in a bullish market or a bearish market, because if you are looking at a bullish market and you constantly keep identifying potential distributions, then you shouldn't really be surprised if you keep getting taken out of the trade. Higher time frame bias is also extremely important. Sometimes you want to take a swing trade, but you tend to ignore what you see on the daily or weekly time frames, which it goes without saying. If you're ignoring what the higher time frames are telling you and only making a decision based on the lower time frames, then you cannot even be looking at such long-term trades. So you always have to take into account what the relative higher time frame is telling you. For example, you can look at daily or weekly zones that have previously been manipulated, and if that is going to help you with your analysis, or for example, which institutional candles we have rejected on the higher time frames, or which significant areas we have approached on the higher time frames, and then based on that, on the lower time frames, you'd be able to mark up relative accumulations or distributions if the market provides them for you. Supply and demand is also extremely important, because I have seen that sometimes people would be marking up accumulations in zones of supply or distributions in zones of demand. So there's no surprise why sometimes you would mark them up and you would still find that it's going against you. There are other concepts that we would utilize to analyze a chart to be able to have a more clear directional bias on what we are seeing. However, this is not going to be the focus of this specific video. If you have watched part 1 of Wyckoff introduction and you're watching this now, once you finish this video, I encourage you to go and watch some of the other trade breakdowns that I have posted on this channel to get an idea on how we would use multiple different confirmations alongside of each other and alongside of Wyckoff to then come up with a trading scenario and execute the trade. Before we start to break down the exact schematics, I really want to talk about some of the similarities of Wyckoff concepts to some of the retail elements of analysis that a lot of us have used in the past. You have probably seen me use divergence in the past as well, and the reason behind why I wouldn't use that right now. Again, this is not a training on what divergence is, but if you know what divergence is, you know that oftentimes you see that the market continuously is creating higher points, whereas when you compare that to your oscillators, whether that be MACD, whether that be RSI or stochastic, whatever you want to use, you will find that in the same areas, the oscillator has not followed. The market has created higher points, but your indicators have created lower points. This can go the other way as well, where the market is creating lower points. However, your oscillators, again, are not following. These indicators are meant to be following what the price does. And when you see the market going lower, you would expect the indicators to follow. But sometimes this just does not happen. And this is one of the methodologies that I used to use a lot within my analysis. And this is quite similar to Wyckoff as well, because in the areas that you can find divergence, oftentimes you would be able to mark up some type of a schematic as well. This is the same example that we looked at just now, where the market has continuously created lower points. However, our MACD or the RSI in the same areas has not followed. The MACD or the RSI have not created new lows in the same area. They have created new highs. Or if we want to look at the other example, this would be where the market has created new highs in a way, So it's continuously created new highs. However, within the oscillators, we have created new lows. Now, some of you who know what divergence is, you know how we would use these for analysis, or at least how we would use them for our analysis. The entire idea behind it was if we are identifying some type of a divergence, in this case, this would be a bullish divergence, so we would expect the market to go higher since it's in a way converging towards each other, these two lines. And in the other scenario, since they are diverging away from each other, would expect the price to drop. Now, this is similar to Wyckoff, because the general idea behind Wyckoff accumulation is how we are creating new lows in the market and then it will reverse, or an area of low volume market. And by volume, I simply mean that we haven't really moved a lot. It's that area of consolidation that we are looking at before going higher, or in this case, area of consolidation, creating new highs before we go lower. But the reason I do not use this divergence as a method of analysis, especially alongside of Wyckoff anymore, is oftentimes when you want to trade based on divergence, you will have scenarios that simply will not play out. What I mean by that is looking at this same scenario, this initially would have been a divergence. So if you were looking at this live, maybe you would have identified this as creating a new low, and now you can look at your MACD or your RSI and see, hey, this has now created a new high. We are diverging, or in this case converging, whatever you want to call it, and we have broken structure to the upside. Therefore, we should be looking to buy this to the upside, only to in a way be trapped in that range and eventually be taken out of your trades just before this market starts to have its markup phase and start to have its rally going higher. Now, the reason I wanted to compare Wyckoff to the more retail methods of analysis is I need everyone to understand that these concepts are not far from what you already know. It's just a lot more detailed way of looking at maybe a lot of the similar trades that you were looking at in a way that you're not going to be taken out of your trades, or in a way that you can have much better risk to rewards in place. So again, don't alienate it for yourself thinking that this is something completely different and this is something that you really don't know about, because believe me when I say a lot of institutional concepts, and this is something that I will be breaking down in future videos as well, a lot of these concepts are very similar to the concepts that we have been taught previously in the retail methods of analysis. However, within the institutional style of trading, and I'm using institutional style of trading as a very big umbrella term over here, we tend to just be a little bit more accurate, and we tend to just look at the same zones from a completely different perspective. So for example, instead of constantly being taken out of this trade, we would wait for the entire schematic to form and then break structure, and then we would trade it to the upside accordingly. Or in the other case that we spoke about previously, we would obviously wait for the distribution schematic to kind of form completely, break structure, and then we'd look at certain trades to the downside. Now that is quite important to understand, because learning about Wyckoff concepts requires patience, not just the learning element of it, but even identifying them on your charts. You have to have that patience to allow the market to develop enough, allow the schematic to form completely, and allow the supply and demand, the necessary supply and demand, to be introduced to the market. And once all of that is done, that's normally when we'll get the major move. So within these concepts, you have to have this patience so you are not taken out early from your trades. I don't want to go into too much more detail about the retail methods of analysis and Wyckoff, so I'm going to jump straight into the accumulation and distribution schematics. One of the first things that I want to talk about when it comes to accumulation and distribution schematics is that there are many schematics for both of them. If you simply just Google it, you will have access to many different schematics over here. This is all available to you for free, so you can see your accumulation schematic number 1, distribution schematic number 1, distribution schematic number 2, and if you search for accumulation schematic number 2, you'll probably find it somewhere as well. So all of these schematics is available for you for free, so you can go and download it and save it and do whatever you want with it. But the purpose of this video is not for me to teach you the exact schematic. What I mean by that is we are not pattern traders here. There's no point looking at these schematics and think to yourself, oh, a high, a low, a lower high, lower low, and this is the exact same thing that I need to see on the charts. No, the purpose of this video is to help you understand the market behavior behind it. So you know that even though there are many schematics for accumulation and distribution, every single one of them in a way are the same. Every single one of them are a way for you to be able to read market behavior. So if you really understand why it's accumulating and distributing and what is an accumulation and distribution more than the schematics, then you don't need to be so dependent on the different schematics and all of a sudden go from a Wyckoff trader to a pattern trader, someone who's really just looking to identify patterns and trade those patterns. So we showed accumulation schematic number 1 and distribution schematic number 1 in the previous video, but as I said, it's just a simple Google search, so go and download these pictures for yourself if you want. I'm not going to really be kind of talking about the pictures in this case and speaking about the pictures right now, because I want each and every single one of us to get a better understanding of every single one of these highs and the lows in the market and why they take place and what the meaning behind all of these little letters and all of these little abbreviations are. To do that, we are going to be looking at CADJPY on the hourly time frame and this accumulation scenario that took place on 18th to 20th roughly of November 2020. And again, instead of me describing what they are on the actual schematics, I want you to understand and see them on a live chart for it to make a little bit more sense, for you to see that what you see on the schematics is not necessarily going to be exactly what gets printed on the chart. So let's go back to the definition of accumulation that we spoke about in the last video, and that's very simple. Accumulation is a manipulation of the lows and a break of structure to the upside. The general idea behind accumulation is we are constantly manipulating the lows or constantly reaching below the previous zones of support that this market creates, grabbing that liquidity and then having a major rally to the upside. Now, these manipulations go a little bit further than just zones of support and resistance. When this is creating, you probably have a lot of people who would be drawing their, let's say, trend lines over here. So the manipulation to the downside goes a little bit further than just the zones of support and resistance. It's also taking out people who are drawing their trend lines or, utilizing their Fibonacci's or whatever it may be, because they think that this may be the bottom of the market, and in a way having those buy positions but quite early on. Now, the first point of an accumulation is your preliminary support. So for each of these, I'm actually going to write exactly kind of what they represent, or at least what they mean as well. So this is our preliminary support, which in a way, the best way to describe this preliminary support is simply think of the first substantial point of support that this market has found. So within this entire decline over here, probably this point over here is the first substantial point of support that the market has found, and you can see the rejection that kind of followed after that as well. Now, don't think to yourself that if you see this live, any random low you can go ahead and identify as a preliminary support. That's not how it works. Oftentimes we need to see the schematic form more and more and more, maybe even completely form, before we are even able to mark it up. And we definitely would want it to be fully formed before we execute any trades. So this is now where I can look at that as our preliminary support. Not that preliminary support is not important, but when it comes to marking up Wyckoff schematics, the selling climax is the point that I personally care about a lot more. I personally look at this selling climax as a potential trap, and this trap is the panic sellers getting in. So the people who are seeing this decline and seeing that the market just in a way broke below the previous structure points, they have fear of missing out. They expect the market to go lower, hence that's where they are opening their sell positions. An easy way to look at it is this is the first major rejection that we get after this markdown phase. So in a way, the market has been declining and declining and declining, and from the selling climax all the way up to that automatic rally or the sign of strength, which is not really on the actual schematics, but I'll speak about that a little bit later, that oftentimes is the major rally away. That's oftentimes the major move away from that zone of support, hence actually enticing some early buyers later on. People who think that this is the bottom of the market, and when we approach the same zones of support, they look to buy into that currency pair, again, only to be manipulated out. Remember, manipulation of the lows and a break of structure to the upside. When you look at the accumulation schematics, this is how it's actually marked up, where from the selling climax, you have in a way a low, high, higher low, and a higher high. Your typical 1, 2, 3 wave to the upside. And this is also another place that I believe a lot of people who try to identify Wyckoff get really confused, simply because they always expect to see this perfect low, high, higher low, higher high. It wasn't really a higher low, but low, high, higher low, higher high move to the upside. More than looking at it from that perspective, I want you all to be able to see that from selling climax to the rally that we get that creates the high of that range after that selling climax. And by range in this case, I don't necessarily mean the accumulation range, I simply mean the high that we have created within this area. So an easy way to identify it is looking at what has happened within this area. Have we had a major rally away from what you can see as a selling climax? If the answer is yes, then potentially you have marked up the correct one depending on what happens after. So normally after a selling climax, we have this automatic rally back up, which in a way that's our first major rally away, following by a secondary test. And normally these secondary tests are simply testing areas of supply or demand within that trading range. And it doesn't just have to be one of them, there could be multiple, both at the highs, at the lows, everywhere. So instead of getting confused with the entire markup, I want you to think of this as, okay, we have a preliminary support and a little rejection from that preliminary support. And once we form the seller's climax, we have a major move away. Whether this move is one major rally up or is like a little step-by-step rally, or in a way your 1, 2, 3 wave to the upside, it doesn't really make a difference. The entire point is we've gone from the selling climax all the way up to be able to identify an automatic rally, or in a way I call this our sign of strength, because in the distribution schematics, the exact opposite of this is called the sign of weakness. One of the major reasons we create this rally to the upside is the institutions or the bigger players that have been in their sell positions from wherever the high of the market was, oftentimes start to look to get out of their orders around the selling climax. And once they are getting out of their sell positions, you will observe this rally to the upside. So sometimes you might have seen in my videos, instead of me marking this up perfectly like what you see in the accumulation schematics, I simply look at it as selling climax and a major rally away from that selling climax, whether you want to call that your automatic rally or you want to call that your sign of strength, because in a way that is a sign of strength. That is a minor area of demand. As mentioned previously, you oftentimes get multiple secondary tests in the same range. This is another example of a secondary test where it simply has come back to, in a way, test that previous zone of demand. However, one of the major secondary tests is the secondary test that happens in phase B. And again, we're not going to talk too much about the Wyckoff phases right now. Maybe in another future video we will go into detail about that. But the way that I want everyone to look at secondary test in phase B is this is another manipulation of the lows. So think about it from this perspective. The selling climax has manipulated those previous zones of support, and once it got created, it also created other zones of support to be manipulated in the future. What did we say? Accumulation is a manipulation of the lows and a break of structure to the upside. So within this entire range, we are taking the lows, manipulating the lows, and secondary test in phase B, which could form below selling climax. And I would like it to be formed below selling climax rather than necessarily at the same level, is oftentimes just manipulating the previous lows, is another push to the downside to take out whoever those early buyers in the market were. The major final point of an accumulation is the spring that gets created. Now, the spring is the final push below all of those previous lows before we get the rally higher. So the spring, in a way, is the final manipulation of all of those previous lows before the market goes higher. In accumulation schematic number 2, we don't normally get a spring. So once we have formed that secondary test in phase B, that normally is that final push to the downside. And from there, we start to get the markup phase and observing the market reaching higher and higher and higher. There's other points within the accumulation schematics as well, such as the tests and the last points of support, the LPS, and other signs of strength in the later stages of an accumulation. But these are some of the more major points that you need to identify within an accumulation. Now, here's a fun way to actually look at all of these different abbreviations. We've just spent so much time going through what all of these different abbreviations mean and what the purposes of all of these different abbreviations in a way are. But does it really matter if I call that preliminary support or if I call that pips? Does it really matter if I call that, for example, the selling climax, or I go ahead and call it pizza? Does it matter if I go ahead and write that as spring or write it as Scooby-Doo? It doesn't really make a difference. And the point that I'm trying to make here is don't be so invested in each and every single one of these abbreviations and all of these different lows and the highs and trying to match what you see on the charts perfectly to what you see on the schematics. It doesn't really matter what we go ahead and identify all of these different points as. Don't be too invested into that part of things. Instead, observe the market behavior. This is where we have constantly reached below, constantly been taking the previous zones of support. That's a previous zone of support. This is a previous zone of support. Zones of support. We have constantly been manipulating this to the downside while consolidating and while we can see the market is definitely range bound. And once that has taken place, we can start to see elements of very clear breaks of structure to the upside wherever you want to go ahead and identify your structure points. Some people would get really anxious thinking, hang on a second, if I want to wait for all of these breaks of structure to take place, then I'm going to miss out on a lot of pips and I'm not going to really be able to have that optimal entry point. I want you to understand that that doesn't really matter, because oftentimes when we have the patience and we wait to get proper confirmation that we have manipulated the lows and broken structure, the re-entries that this allows us to have are not only a lot higher probability, but we also tend to get higher risk to rewards, because these are the parts that I would be able to then zoom into the lower time frames and find lower time frame schematics and execute based on them. Let's quickly have a look at the distribution example as well. I'm not going to be spending too much time on the distribution again, because this is simply the opposite of the accumulation that we just spoke about. So your preliminary supply is simply the opposite of that preliminary support. The same way we said at that preliminary support, that's where, we've seen some slowdown in the previous bearish move. This is the slowdown that you will see in the previously bullish market, where we have rallied higher and higher and higher. And this is in a way the first point that the supply might have been introduced into the market. And following that, within a distribution, you get a manipulation of the highs and a break of structure to the downside. So more than looking at it again from a schematic perspective, more than looking at it from all of these different abbreviation perspective, I want you to look at it how we are constantly taking the highs, how we are constantly creating areas of resistance and manipulating these areas of resistance. And once we have taken the highs, you will see, or we at least want to see, breaks of structure to the downside, which will then confirm the distribution, allowing us to sell this to the downside. But let's quickly speak about the different abbreviations as well and go through them at least. So preliminary supply, we just spoke about that. Buying climax. This is again where oftentimes you will see the larger institutions little by little getting out of their orders, closing these previous buy positions, and hence you will tend to see a move down from that buying climax. In the distribution schematics, you will tend to see buying climax, automatic reaction, secondary test, and then sign of weakness, this high, low, lower high, lower low formation. But that's not the way I would necessarily always want to look at it, because that's not necessarily something that you will always be able to identify. The bottom line is, from your buying climax to the move that we get down from there, you should be able to identify a more substantial move to the downside. Oftentimes you will even see the sign of weakness perhaps be created below some of the previous zones of support, which in a way is another retail trap, where people would identify that as a break of structure, wait for that pullback, and then wanting to take their sell positions maybe over here. And even if they manage to catch this to the downside, eventually they will be either hitting stop loss or the break even scenarios. So normally within the schematics, you will get the buying climax, automatic reaction, where that's kind of the first move to the downside that we have gotten from that buying climax. Following the automatic reaction, you will get secondary tests, and these are often secondary tests of the highs that have created, and then you will get the sign of weakness. But I want you to look at this from the perspective that from the buying climax, we have a major move down, hence this is now showing signs of weakness. This is still way too early on for you to even know if this is a distribution. So oftentimes we have to wait for this entire range to fully form and break out of that range, and then we'll trade accordingly. Goes without saying, in the same way, within an accumulation, after the selling climax, you have manipulation of the lows. within a distribution, after forming that buyer's climax, we tend to see manipulation of the highs. We tend to see the market moving higher, reaching above the buyer's climax to, in a way, grab whatever liquidity that's over there to allow a more smooth move for this market lower. The UT that forms after the buying climax stands for up thrust, and this in a way is simply the opposite of that secondary test in phase B. In distribution schematic number 1, similar to accumulation schematic number 1, we have this final push to the upside, which we call it the up thrust after distribution, where in a way, again, this is the highest point that we'll create within that distribution range. This is the final push above all of these previous highs and all of these previous zones of support. Whoever who's buying this early on is now getting taken out by this UTAD, by this up thrust after distribution before we visit lower. Up thrust after distribution, again, you can look at this as the opposite of spring, which means in distribution schematic number 2, you are not able to see that up thrust after distribution. More than being so worried about how to identify all of these highs and the lows and, how to actually go ahead and label them, I want you to understand the behavior behind it. In this range, yet again, we are manipulating the highs and we are breaking structure to the downside. Once we have created this consolidation range, you can see that we are constantly taking the highs. We are manipulating those highs and we are reversing almost instantly. And once the market has manipulated all of those highs, you will tend to see breaks of some major structure points to the downside. And once you observe those breaks of structure to the downside, you simply can wait for these last points of supply be created, LPSY, last points of supply, before we visit lower. Now, I'm going to be fair and I'm going to speak in a little bit more detail about this specific picture because I know a lot of you are now wondering, hang on a second, if you were seeing this live, you might have actually looked at that up thrust as the final push to the upside, since after that up thrust formed, we actually broke structure to the downside. We went below this previous structure point. So wouldn't you have taken your sell positions maybe based on these final candles over here with your stop losses at the high? For those of you who have been watching the videos in this channel for a little bit longer, you know that I always like to describe this from a trade management perspective more than necessarily knowing how you would or wouldn't have taken the trades in this case. So instead of me telling you why you wouldn't have taken the trade in this case, that will come later on in other videos, I am going to speak about, let's say you did. Let's say you had a position over here and you wanted to sell it to the downside with your take profit wherever, and you waited and boom, you've been taken out of this trade. That's, let's say, 1% or 2% or 3% or however much you are risking of your account, loss. Okay, cool. That money is now gone. You wait, you have patience, and when the market creates something like this, now you're more confident because the entire distribution schematic is now completely formed based on what you can see. You got your final push to the upside and the break of another major structure point that were just created to the downside. And if you were looking at these types of scenarios, then obviously you'd be looking at entries probably somewhere over here. There's a 5-minute institutional candle over here, if I'm not mistaken. Yeah, this 5-minute candle. And you could have even taken your trades potentially within these ranges. So even if you had a losing trade previously with correct risk management in these scenarios, you would simply have patience, you would observe what the market is showing you, and eventually allow yourself to have other entry opportunities, which not only would have covered the previous losses, but would have also given you a lot of profit on top of that. And this is exactly what I mean when I say sometimes people get way too invested in which schematic is it and where do I mark up and this and that. Calm your mind. Approach the market from a little bit more calm perspective for you to know that even if you take 1 or 2 losses before you manage to catch the right trade, so long as your psychology is in place and you are looking at the correct accumulation and distribution, then chances are you'll be looking at good risk to reward ratios. Hence, you are able to lose even 10 out of every 12 trades and still come out profitable. Obviously, that's not the aim, but that should be a little bit peace of mind for anyone watching this video right now. Anyway, if you want to know more information about this specific distribution scenario, this is actually a scenario that we have broken down in one of our previous videos. I'm going to link it in the description below. It's a CADJPY case study on this specific distribution scenario and the sell positions that we took to the downside from there. So feel free to go and check out that video to get full information about the exact behavior that was observed and what else that led to the trade execution based on this distribution. So going back to these accumulation and distribution schematics, hopefully now you have a better understanding of what each and every single one of these points actually mean, but more than that, the behavior that gets formed before we have the moves that we want to be catching in this market. To recap very quickly on some of the more important points of an accumulation, once we form a selling climax, you can oftentimes see a major move away from that level, creating this automatic rally or the sign of strength up here, where you can clearly see that that is where previous bigger sellers in the market have now closed their positions, or maybe some early buyers have gotten in. Following that, you'll get a secondary test which tends to manipulate the previous low, and a spring which tends to create the complete low of that entire range, taking whatever stop losses that was still left open, whoever who was left in their positions probably getting manipulated out, those early buyers, before we have the rally higher. And in accumulation schematic number 2, that secondary test in phase B will be the final point, and oftentimes you will see the rally from there. You can look at the differences between accumulation schematic number 1 and number 2 based on the behavior that gets formed once we start to have that markup phase. And if you're confident it is schematic number 2 and we are not going to have that final spring to the downside, then it goes without saying you'll wait at one of these pullbacks, or you wait for the market to approach some previous zones of demand before this goes higher. And within a distribution, you have that major buying climax, which you tend to see a major move down from there, creating that sign of weakness, where again, that's where potentially the bigger institutions have closed their buy positions, resulting in this market going lower, or the early buyers getting in. And following that, you tend to see manipulations of the highs with the upthrust, or the upthrust after distribution, where we tend to, cross above those previous highs, take whatever stop losses that's still left open over there. And the UTAD is simply the opposite of the spring. So it's the highest point that we create within the distribution range before we go lower. And in the distribution schematic number 2, we do not even see that UTAD. So once we have formed the upthrust, you tend to then see the market maybe rejecting some previous zones of supply and then dropping lower, breaking more structure points to the downside, rejecting other areas of supply, and going lower and lower and lower. I encourage you to watch and re-watch this video to get a more detailed understanding of each and every single one of these points and the behavior behind it. And I also encourage you to go and do your own research when it comes to these concepts. Read a little bit more about Wyckoff schematics to understand it a little bit more. But now you have the base knowledge that you need for you to go and watch some of the other case studies that I have recorded, and you will have a much more detailed understanding of everything that I have spoken about in those videos. Because with what you know right now about accumulation and distribution, when you watch the other case studies that are available to you on this channel, you can easily understand and internalize the market behavior and see other elements and other confirmations that we would use for trade execution. But here's what I'm going to wrap it up with. A lot of you watching this right now want to learn more about Wyckoff, and you want to know what's the best way to do it. When you ask people who have been trading Wyckoff and who are confident trading Wyckoff about how they got to where they are, oftentimes the answer is an insane number of hours on the chart, analyzing, backtesting, practicing, forward testing, and simply just being in the zone and practicing and learning and making mistakes until you get it right. So I want you all to be able to backtest this the correct way. Do not go back in the chart, identify accumulations and distributions, and think to yourself where I would have bought or where I would have sold. If this is one of the first times you're getting exposed to Wyckoff and you're trying to know more about it, there is no point to go back in the chart and think to yourself, oh, I actually would have bought it over here because I would have seen this accumulation. Or I would have sold it over here because I would have seen this distribution. When you do this, you are actually getting rid of a lot of important things that happen when you're executing trades live. So the aim is not to go back in the chart and find out where you would have bought or sold. Right now, the aim is to get your eyes used to seeing these schematics. So go back in the chart, whatever currency pair and whatever time frame you want, find areas of consolidation and see if you can mark up those areas of consolidation with accumulation and distribution schematics. Now again, there's no need to see where you would have bought or sold. That's not the aim. You simply want to go back on the chart, find these areas of consolidation and see if it matches accumulation and distribution, mark them up to get your eyes used to seeing the schematics. Also, don't force the schematics. Just because an area is consolidating, don't think to yourself, okay, here is definitely accumulating or definitely distributing, and this is definitely the correct markup for it, right? Don't force the schematics. Go based on what you see. And if you're unclear about one of the trading scenarios, there's many other things that you can look at, many other pairs, many other time frames for you to then be able to get your eyes used to seeing these schematics. The best way to learn about these concepts more and more is forward testing rather than back testing. So instead of going back in the charts to see where you would have bought or sold, go back in the charts, get your eyes used to seeing the market behavior. Once you're more confident, analyze fresh charts and paper trade. Mark them up for yourself, save them on your trading view, and come back to them in a few days and see if it has or hasn't played out. If it has played out, then congratulations, you've probably marked up the correct accumulation or distribution. If it hasn't, now you have a case study that you can learn from. Organization and documentation in these cases as a trader is extremely important, especially if you want to take this on full time. Now, in the previous video, I mentioned that I'm not clear whether or not I want to have a part 3 to this kind of Wyckoff introduction series. By the looks of it, there might even be a part 4. So there's definitely going to be a part 3, which I'll try my best to release next week, which we're going to speak in a little bit more detail about reaccumulation and redistribution scenarios. And if I don't manage to cover everything I want in these 3 videos, then I'll look to record a part 4 of this kind of introductory series as well, to kind of put everything together and have a look at some chart examples and go into a little bit more detail in regards to Wyckoff. But as of now, make sure to study the previous video, the part 1, make sure to study part 2, go back in your own charts, learn the schematics properly, practice them properly, have a look at the other case studies that I have posted on this channel as well, so you can see them in action, so you can see before and after pictures of them. And as usual, if you got value from this video, make sure to press the like button down below, press the subscribe button if you are new. Welcome to the family and welcome to the community. I'm looking forward to seeing each and every single one of you elevate and each and every single one of you achieve your trading goals and dreams. But with that being said, let's catch some pips.